Hi there. In this video, I will be showing you how to prepare a question on inventory. This question is taken from Clementi Town Secondary School 2016 preliminary exams for the Sec 4 Normal Academic paper. Now, in an inventory question, it is typical to provide you with a list of table with all the inventory that's being purchased and its original cost. And they will often ask you to prepare the inventory account, which in this case is being asked in part B. But in this video, I'll be showing you how to answer all the questions here. Now, when you're preparing the inventory account, you must always look out for three pieces of information. The first one is the beginning inventory amount that's available in the warehouse or in the business. So at the beginning of the month or the financial year, this business has got 40 units of inventory, and its original price is actually 2,150. And here, next, they also mention how much inventory was being purchased. Because as a business, when you keep on selling your goods, you need to replenish with new goods. So the new goods come in on the 4th of May, 20th December, so on and so forth. So these were the goods that you bought, and this is the price that the business bought from the supplier. So of course, after you buy your inventory, you would have to sell it away so that you can make a profit. And you sell these goods, in this case, 240 units of inventory on the 28th of December 2015, and you sell it at 35,400. Now, remember that this is the selling price. Therefore, the selling price will always be higher than the cost price, the original price. Now, this is very important for you to remember because it makes a difference later on when you are calculating the cost of sales or the inventory account, because you might be taking the wrong figure. A lot of students do that. Okay, I will show you how to do it the proper way. And also, the business sells another set of goods, 120 units, on 27th February 2016 for 20,670. Again, this is the selling price. Now remember that for the inventory chapter, there is only one way of recording inventory that we learned, and that is the FIFO method, which is the first in, first out method, meaning a business must always sell its older goods first before selling away the newer ones. Anyway, having lots of inventory seated in the business for a long time is not good, especially when they are perishable. So, always remember to sell the older ones first. You can't just sell whichever ones that you like. Although in reality, that may not be the case. So now, let's answer part A, whereby they ask you to calculate the cost of sales for the year ended 28th February 2016. So this can be just represented in a mathematical equation. You don't have to prepare any accounts or ledger accounts. So here we go. To calculate the cost of sales, one thing you must note is you must always use the original price of the inventory, because the cost of sales is always taken from the original price. Whereas for the sales revenue, if they ask you to calculate the sales revenue, then you just take the 35,400 plus 20,670. But like I mentioned, the sales revenue will always be higher than the cost price. So here, when you are calculating the cost of sales, always remember to go back to the original price of the inventory. So writing it down here, first of all, you must note, which were the inventories that were being sold away. In this case, the business sold 240 units and 120 units. Where do these inventory come from? If you're going to add the 200 and the 440 units here, and 80 with the 40 here, you're going to get the answer wrong, because you forgot that the business actually had beginning inventory on the 1st of March 2015. So what we're going to do is, on your piece of paper, a good practice is to list down what was the beginning inventory balance that the business had at first. And in this case, the business had 40 units and at a cost price of 2,150. So when the business sells away the 240 units, they actually sold the 40 up here and the 200 on the 4th of May. And when the business sells the next 120 units, it is actually taken from this date. So if you were to use a pencil and draw a line, okay, to indicate where it stops, where the selling of inventory stops, is actually here. So what happens to the remaining 40 and 100 units? They were actually left unsold. So they remain as inventory in the warehouse for the next financial year. So to calculate the cost price, you need to take these four amounts. So to continue this, we're going to add and you'll get an amount of 30,550. Simple enough and straightforward. So that's for part A. In part B, they ask you to prepare the inventory account for the year ended 28 February 2016. So here, whenever you see the word prepare an account, the word account here, it means that you are to prepare a ledger account. So you need to have the debit, credit, and the balance columns. Don't forget your dates and particulars as well. So the financial year starts on 1st of March 2015, ends on 28th February 2016. So when you start, you will start with the beginning inventory of 40 units. Alright, whenever you start an inventory account, in this case there was initially 40 units worth of 40 units of inventory worth $2,150. You need to write this as balance brought down. Write it here. Okay, don't forget the DR or CR. Since this is a asset account, we are going to write a DR because this is a plus minus account. Right, and the next thing is, when you're preparing the inventory account, you must include all this information into the ledger account. But you cannot do it any way you like. You have to prepare it in a chronological order, in date order, proper order. So after the 1st of March, we have 4th of May, and then we have the 20th of December, and then don't go straight to 13th Jan. You go down to the selling date, which is the 28th of December. Next, go to 13th Jan, and then 14th February, 26th February, and then you go to your selling date on the 27th February. Okay, so it's simple enough. Now, when you're preparing this entry, let's say the date where you buy your inventory, you have to make sure that you got the particulars right. So when you buy inventory goes up, you are going to debit the amount, 17,300. That is pretty clear cut. But the particulars in this case, there's two ways. Either you pay cash to the supplier, or you owe them money first, you pay them later. How do you know? Go back to the question and see here that the business actually bought inventory on credit from Mark. So the word on credit here means that it is going not to be going cash or cash at bank or cash in hand. It's going to be trade payable dash Mark. Simple enough. Then we have another December 20th. Okay, same. And we're going to add the next 2950. Okay, now the next thing is we're going to go down to the selling date on the 28th of December. Here is the date where you sell the inventory. So definitely your particulars is not going to be trade payable. Okay, let's settle the easier one, the money, which is it will be minus on the credit side because inventory goes down when you sell it away. So you're gonna write 35,400. Now this is where students will go wrong because they just immediately say, take this amount and put it here. Take note, this is the selling price. It is always higher than the original price. So we can't take this one because the inventory account will only take the original price of the inventory. So you have to decide the total property units that you sold away is actually these two amounts, the 2,150 and also 17,300. So it is actually 19450. So 19450 is made up of the 2150 and 17,300. Particulars wise, it'll be cost of sales because you sold your inventory. And inventory, when they're being sold, they are sort of converted to become expenses. So the expense here is called cost of sales. Okay. Write your working here next to the name of the account so that the examiner knows which figure you took it from. Alright, now moving on. We are going to have the next date on 13th of Jan. And here's when you buy another set of inventory. So trade payable at 8150. Next we have 14th of February. We buy another trade payable and we're going to add 4,000. And last but not least, we bought again from trade payable mark February 26th. Okay, here you go. So having done the first round of selling, now we're going to do the second round of selling on the 27th of February. We're going to write cost of sales, but the amount's not going to be that amount. So which amount do we take? We have sold the first two. The next two sets, the 120 units, is actually from here. Let's highlight in different color. It's actually 2950 and 8150. So you actually have to add those two figures instead. Okay, and you credit the amount 11,100. And you would have a balance of these two left, which is 14,000. So don't forget to have a closure. March 1st. Another balance brought down of 14,000. So that's about it for the inventory account. We'll answer part C and D in the next video.